let me begin by asking you that in the last 45 days, we have seen a sharp correction, whether in terms of Indian market, which has gone up by almost 14%, or even NASDAQ, which is higher by around 11%. Is this one of those sharp bear market rallies, or do you think the worst is behind?
Absolutely the former. I think this is a bear market rally. We are moving in a regime change, from QE to QT. And often on the way down, you will see a lot of these sorts of bear market rallies. And I think don't fight the Fed comes to mind, which is in this context, instead of buying the dip, you sell the rip.
Okay, so that's a very clear view coming in there. It's still a bear market rally. But Rupal, if that's the case, how should one reassess their portfolio? What's the right strategy at the moment? Because over the last couple of years, being in equities has worked really well for investors. How does the portfolio allocation should look like for the next 2 to 3 years?
Sure. I think I go back to my original point, which is investors need to appreciate there is a regime change. Regime changes last for many, many years, not just for weeks or quarters. And that specific regime change is not just about inflation and rates going up, which of course everybody is watching. It's about the Fed announcing that they are moving from quantitative easing to quantitative tightening. In a QE world, the more risk you took, the more you were rewarded. And one of the risky asset classes tends to be equities, which is why they performed as well as they did. On the flip side, in a QT world, risk gets penalized. And so I would say the biggest thing to avoid and the way to take advantage of this rally is to sell junk bonds and junk equities, because that's where the biggest risk tends to be. Now, you might ask me, what do you mean by junk equities? Because not all equities are junk, right. And I'm not suggesting you sell all your equities. But junk equities are characterized by the 4 L's. L number 1, highly loss-making companies. That's where the biggest pain has been, as you've seen, especially in the new IPO market, where a lot of companies who don't make money have crashed. The second L is highly leveraged companies. Financial leverage, balance sheet risk is something you don't want to take in this environment of QT. The third L is companies whose stock prices have very lofty valuations. Because growth is going to disappoint, in fact, we might have a recession, stocks which price in way into the future, expectations are going to be extremely exposed and vulnerable. So lofty valuations is one to watch out for. And the last L is the stocks which I would argue have ludicrous expectations. And that would be a lot of the growth companies which are overhyped and overvalued. And so those are the 4 L's which I describe as junk equities. It doesn't matter if you're invested in global equities, US equities, Indian equities, junk equities are going to be in trouble in the foreseeable future.
Okay, so stay away from junk equities, and that's defined by loss-making companies, leverage plays, lofty valuation, and ludicrous expectations and valuation. So those are the 4 L's to avoid at the moment. But Rupal, since you talked about the Fed tightening and the way US Fed upcycle is moving, do you expect this hawkish stance to continue, or given the fact over the last 2 quarters we have seen a negative number come in terms of the GDP for US, there is a bit of expectation that there might be a bit of a change of course, or maybe a bit more dovish tone coming in from the US Fed going forward? What's your take?
I think that was certainly the assessment of the market yesterday, but it's going to start changing because already all of today, a lot of the other Fed members on the board started to backpedal what the Fed was trying to broadcast, that they are nowhere near done, that this is not something that they can call as the top of the yield curve being about 3.5%, which is what the market seems to be pricing in as a peak. They're very much in data watch mode, which is to say that if inflation continues to remain high, they're going to be extremely vigilant, and they're going to raise rates far ahead of, I think, what the market is pricing in today. So I would say I don't agree with the market's assessment yesterday at all, that we're towards the end of the cycle. We're actually still in the very early innings.
Wow, we are at the start of the innings and not into the later part of it. But Rupal, we have seen the inversion happening of the 10-year as well as 2-year. would you say that we are already in a recessionary environment, or do you see that happening? Are you of the camp that this is more of a possibility rather than a probability?
Well, technically, the US has already been in a recession because we've got 2 quarters worth of GDP data that has come out negative. So I don't think that's per se up for debate. I actually think it gets worse from here rather than better. I think that the classical recession, which only lasts 2 quarters, is the least baseline. I actually expect that the economies to continue to slow because, by the way, that is exactly what the Fed wants to do. You see, inflation is at a 4-decade high, and interest rates are nowhere near a 4-decade high. We still have negative real rates, and that's very important. Just because people's appetite is for rates to not go up above 3.5%, does not mean that's what the markets will oblige. I would actually say that you should watch inflation in the US. Unless inflation comes down, even if it means a recession, even if it means a protracted or prolonged recession, the Fed's mandate and priority right now is very clear. It's to contain inflation. And the reason for that is inflation expectations are getting embedded. That means the horse is way far away from the barn. And to get that horse back in, you need to overdo the rate raises, not underdo them. So just in the same way that shock and awe, was the approach during QE when people were very afraid, I think the same has to happen when it comes to rate hikes. So that's what I would watch out for.
So Rupal, US is in or is headed for a protracted recession. So is this the right time to perhaps look at emerging markets? How do those stack up in your investment thesis? And more importantly, does India make make any sort of a name in that list?
Sure. Just to be clear, I tend not to be a macro investor. I'm not a top-down investor. And sometimes, even if economic growth is challenged, as I expect it will be in many parts of the world, developed as well as emerging, there are still investment opportunities to be found because the stock market is a discounting mechanism. And to answer your question, I think that some of the best opportunities are in emerging markets, except not in India. One of the areas of the world that I think is particularly cheap is Latin America. In Latin America, the commodity exporting regions like Brazil, Peru, seem extremely undervalued. In fact, Brazil is one of the cheapest markets in the world, and there are some world-class companies that are available for bargain basement levels, close to sort of what the kind of valuation levels we had even during the great financial crisis. So I think that India, on the other hand, still has a lot of buoyancy and still a lot of bullish expectations embedded in the market, and frankly has performed quite well over the last decade. Quite the contrary in the case of Latin American markets. And again, I would call out Brazil in that regard.
So since we're talking about Latin America and the fact that these commodity heavy countries are likely to do better, is there a case to be made to shift your portfolio a bit towards commodities? And does crypto feature in the list of portfolio allocation for you, Rupal?
Okay, well, two-part question. I'll take the crypto question first. I would avoid crypto like the plague. I think that crypto is one of the highest risk asset classes out there. And I just told you, don't go long risk. I would avoid risk because in a QT world, risk-taking will get penalized. And if you look at the correlation of the crypto market, it's sort of almost like a leverage play on the NASDAQ. And the NASDAQ was a poster child of, risk appetite. So I think that sort of addresses your question of whether I'd be interested in crypto. Frankly, not by a long shot. Commodities, I'm also actually not interested in going long commodities because they tend to be boom bust. And by definition, they're commodities, not franchises. And so I don't like to own them. That said, I think that the commodity boom is likely to last because there are some serious supply chain disruptions, especially in agricultural commodities like wheat, because of the Russia-Ukraine war. And there's certainly shortages developing in terms of oil and again, a whole host of other commodities. But instead of owning the commodities directly, which again, because they're vulnerable to boom bust, I tend not to like direct exposure. Indirectly, one can get exposure to the trickle-down effect of commodity exports and boom in Latin America. So coming full circle and owning Brazilian equities, the financials there, I think are a good way to participate because even if the commodity boom abates, which at some point it will, because recessions tend to do that, you don't want to be facing the price corrections that commodities are known to have very wild swings. But if you own, the underlying countries and the stock markets in those countries which have sold off, the downside is protected because there's a great deal of margin of safety in the valuations. So the financials in Brazil look very appealing on that front.
Okay, so let's get back to equities. And I know you said that you're not really a macro investor, but if you had to choose a particular sector, is there anything that really stands out in terms of consumption, technology, etc.? And even in terms of a class of equities, is it more of dividend plays that you look at the moment, cyclicals or deep value? Is there any area that really looks attractive at this point of time?
So again, I'm not a thematic investor, and a lot of things that you mentioned are themes, but nonetheless, to answer your question as to how should one position one's portfolio, where is one finding value? I would say that, value does tend to cluster. And in particular, I would argue for dividend paying stock strategies would actually work out extremely well in the kind of environment that we have ahead of us, because dividend growth can act as a hedge against inflation, and dividend yield can provide good income, provided you know how to pick the stocks. In particular, only own those high dividend yielding stocks which have very strong balance sheets, because I told you, you don't want to be long leverage companies, even if they are high dividend payers. The second place I think that will work out well, but I'm talking about the US and sort of European stocks here, are in the healthcare sector. Healthcare tends to be a secular growth industry, unfortunately, because you have aging demographics all over the world. Recession or no recession, inflation or no inflation, if you have a disease, if you have a chronic condition, you have to medicate yourself. There's just no choice in the matter. So from that standpoint, I think healthcare is going to become the new, unfortunately, consumer staple. And companies like Gilead, companies like Glaxo, Roche, there are a number of very mature, established pharmaceutical companies that have a number of proven drugs in the stock and the market out there. Those are the kinds of companies I would own in the kind of environment that we have ahead. Historically, healthcare and dividend-paying stocks have done extremely well when you have mega crashes or mega corrections in stock markets of the sort that I think we can't rule out.
And Rupal, let me wrap it up by taking advantage of your bird's eye view, because you're at the vantage point there. Where are the flows really headed? Is it just the fact that dollar has strengthened quite a bit and that is impacting the decision making for a lot of your clients? Where exactly are the flows headed at this point of time?
Well, as they typically do, they are headed into the US fixed income market because people are attracted by the higher yields. And frankly, cash, plain old cash has attracted a lot of flows. People don't realize there's a record level of, repo balances sitting on the Fed balance sheet, because a lot of people have decided, whether it's fund managers or consumers, to simply hold more cash. Finally, you actually make a return on it. And I would say that the flows are going away from risk asset classes. In particular, of course, junk bonds, you find actually the market for new issuance has completely dried up. There's actually no appetite for that at all. So refinancing risk looms very high for indebted companies. And then in the equity markets, I think the market has really come out. The flows have really come out from the more risky end of the market. As I told you, the IPO market has shut down, a SPAC issuance, anything that was, again, the junk equity category has seen the biggest outflows. Frankly, you've not seen enough outflows, in my view, from asset classes that are yet to reprice downwards, which is private equity. I know we focus a lot on public equities because it's visible, but private equities, where a lot of money has been put to work, especially in the US, but globally. And I think that's where the next pain is likely to show up. But I think most of your audience does not get invested there, so it's fine. I would just say the IPO market is very risky, and I would be very wary. Go back to basics, common sense, good old franchises. Even if they are boring, as long as they pay you a good dividend yield, and even if they don't grow too much, heady growth is not what you want to look for. Steady growth is what you want to look for.
Thank you, Rupal, for that sage advice. So don't get into the FOMO mode. Probably just weigh in your investments, and sometimes slow and steady does win the race. So, Rupal, thank you so much for making time and speaking with us. Really appreciate you joining us today.